option trading.
Go ahead.
Yeah, next slide.
So the power of options. So options are a powerful tool used by investors and traders. For investors, they use options to hedge an investment portfolio. They also use it to generate additional income for their portfolio. And they also like to use options to magnify their returns with less capital. For short-term traders, they like to use options to magnify returns and generate profits under any market condition.
Yeah, so one question I have for you guys is, who is the world's biggest option trader? So anyone can take a guess. You can unmute or put it in the chat. Okay, yeah, so Yash is correct. The world's biggest option trader is actually Warren Buffett. Click. Yeah, so he is the world's biggest, greatest, and then click again. So wait, click again. Yeah. So yeah, so he used a strategy called selling index put options, and this is a strategy. Wait, read. Wait, return to the previous slide because yeah. So this is a strategy that he used during the financial crisis of 2008. So he so so he has profited 6.9 billion so far. Next slide.
So there's two types of options, call options and put options. For call options, there's buy call and sell call. For put options, there's buy put and sell put.
Yeah, so I'll explain what a call option is. A call option is a contract that gives the buyer of the option the right to buy 100 shares of stocks and of a stock at the predetermined price on or before the expiration date. So after the expiration date, the contract or the option will expire, so you can no longer use it. But before the expiration date, anytime you can exercise the option. Wait, can you click on the page? So wait. Yeah, so for example, if you want to buy this option on the screen, it's called it's a Apple option, call option Apple December 132 at $8. So 8 is the premium. Wait, can you click again? So $8 the premium. The premium is actually basically the price of the cost of buying the option. So each stock is $8. So one call option is 8 times 100 equals $800. So before the expiration date, you can exercise the option. So for example, when Apple stock rose to 150 before December, you can exercise this option to buy 100 shares of Apple stock at 132. So after buying the stocks, you can sell it immediately for the at the market price of 150, and you'll profit the difference between the price.
So holder and writer. So a call option holder buys the contract from a call option writer. A call option holder has the right to buy the underlying stock and doesn't have to necessarily exercise it. A call option writer is obligated to sell the 100 shares if the holder wants to exercise the option.
Options trading is an alternative way for investors to invest in the performance of a security, such as a stock or an ETF. By trading options, An investor attempts to capture the up or down movement of a security while only investing a fraction of the cost it would take to own the actual security. For example, consider a stock that's currently trading at $100. If you purchased a share and the price went up $5, you would have a 5% return. With the right option contract, you could profit from this same jump in the stock price while only paying a small premium that costs significantly less than the price of owning the stock. The ability to make more with less is one of the benefits of options trading. However, the potential for greater profits comes with greater risk of losses. To help you understand why, let's take a closer look at how an option contract works. Unlike a stock, when you buy an option contract, you're not purchasing the security itself. Instead, you're purchasing a contract that gives you the right to buy or sell a security at a certain price before a certain date. Consider this example. Suppose there's a coffee shop chain called Stone Curb Coffee. Stone Curb stock is currently trading at $50 a share. An investor believes that the stock price of Stone Curb will rise. This investor considers taking advantage of this anticipated price movement by buying 100 shares of the stock, but she is concerned about the initial capital requirement. Now, let's assume that there's another investor. He already owns 100 shares of Stone Curb stock and plans to hold on to it for a while. He thinks that the stock price will not increase much over the next few months. Both investors can utilize a call option. This type of option contract gives the buyer the right to buy shares of Stone Curb stock at a set price, called a strike price, at a set time, called expiration. In this case, it's $55 per share in 4 weeks' time. Typically, each standard option contract represents 100 shares, so this one contract would give the buyer the right to buy 100 shares of Stone Curb stock at $55 per share. The buyer purchases the contract by paying the option's premium. The premium, or price of the option, is determined by several factors, including the stock price, time until expiration, and implied volatility, which is how much the stock is expected to move during the life of the contract. This premium gets credited to the seller of the call option and helps to partially offset the original purchase price of the stock. For this example, let's assume the total premium is $100. Our buyer pays the $100 and purchases the contract. Now, let's examine what could happen to this investment. Suppose our buyer's instincts were right, and Stone Curb stock is now selling at $60 a share. Remember, the call option gives the buyer the right to purchase shares of this stock for $55 a share. The buyer could exercise the call and purchase 100 shares for $55 each, and then sell them at market value for $60 each, making a profit of $5 per share, not including commissions. Because shares of Stone Curb have risen by $5, the buyer's contract is essentially worth $500. If our buyer sold her contract, she could potentially make around $400 in profit, the value of her contract minus the $100 premium she originally paid for it, as well as any commissions and fees. While the buyer's investment paid off, things didn't work out as well for the seller. Although he was able to collect $100 for selling the option, he missed out on a portion of the stock's appreciation because he was obligated to sell his stock at $55 per share. Now, let's rewind. Suppose the stock moved in the opposite direction and is now selling for $45 a share on the last trading day prior to expiration. The buyer's contract gives her the right to purchase shares of Stone Curb for $55 a share. Because no one would want to pay $55 for a stock that's selling at $45 in the open market, the buyer's contract will likely expire worthless. The buyer is now on track to lose 100% of her initial $100 investment, plus any trading commissions and fees. For the seller, the option expiring worthless is good news. He still owns his shares of stock and made $100 selling the option. Although the value of his shares declined, he was able to keep the option premium, less any commissions and fees for selling the option. Keep in mind that this is a simplified example. The pricing of options is very complex, which is why it's important to educate yourself about options and their risks before you invest. While the biggest change comes from the price of the underlying instrument that the contract represents, there are other forces like time decay and implied volatility that influence options prices. While we showed you one example, options can be used in a variety of ways. There are call options, which we just saw, that can be profitable to own if the price of a stock goes up. And then there are put options, which can be profitable to own if the price of a stock goes down. Calls and puts can also be combined in a variety of ways. By buying and selling these options, investors have the potential to make money when the market moves in any direction and create strategies with a variety of risk levels. You've taken the first step in understanding options, but there's more to learn. Open an account with Options trading is an alternative way
Gavin.
Okay, yeah. So what is the difference between buying calls and buying stocks? We can just click through. And just click on the slides. Yeah, just click all the way. So if you, for example, if you want to buy 100 shares of Apple stock, then your investment amount will be 12,000, and maybe a week later the price will increase to 140, and your profit will be $2,000, and your return thus will be 17%. But if you buy one share of Apple 120 call at 6, your investment will only be the cost of buying the option 600. So when the price increases to 140, then you can choose to exercise the option and get a return of $2, which is 333%. Yeah, next slide.
Okay, now I'm gonna walk you through a call option like scenario. So let's say you want to buy one Microsoft call option and it expires January 2021 and the strike price is $210. So if the expiration date is January, that would be January 15th because the options expire on the third Friday of the month. And so the premium for this would be about like $8.45 per stock. So that's times 100, it's $845 totally for this call option. And then your break-even price is $218.70. And that's the price that you would have to cross if you want to make profit. Next slide.
But what if Apple drops to $90? So the people who bought 100 shares of Apple, they suffer a 25% loss or a $3,000. And the people who bought the call options, they only lose $600 because that's the price they originally paid for the options contract. So since options act like contracts, they intrinsically have downside protections. However, if Apple is trading lower than $126, the call option holder will experience a net loss since their break-even price is $126.
All right, so here's like a list of different strategies if you'd like to explore them. And if you'll notice, there's like multiple types of like call and put options. And so a put option is basically the right to sell at a specific price. And it can be used like as insurance when you think the stock price is going to go down. So yeah, that's all we have.